Hi, everyone, and welcome back to Atrium Research's YouTube channel. Today, I have the pleasure of interviewing Marc Bishop Lafleche, the CEO of Ecora Royalties, which trades on the TSX and LSE under the ticker ECOR. We recently initiated research coverage on Ecora with a buy rating and $4 target price, and Ecora released their 2025 full year results last week. Marc, great to have you here.
Great to be here.
So, with that said, I'm going to leave it to you to walk us through the Ecora story. And then, if I have any questions, I'll hop in, but you can take it away with your presentation.
Sure. Well, why don't we start with a quick overview as to what Ecora is? Ecora, as you mentioned, London listed, TSX listed, and actually we also trade on the OTCQX platform if anyone's based in the United States and would like to trade and settle on in the US during US hours. Ecora is a critical minerals focused royalty company. We are, like many royalty companies, very low in terms of staff and central costs, and we're looking to scale that up into a highly diversified copper-centric and base metal-centric royalty exposure. 80% of Ecora's NAV as it stands today is weighted to base metals, and at the core of that is copper. 50% of our NAV is copper. And we've built this portfolio focusing on jurisdictions that are well established from a mining perspective. So approximately 80% of our portfolio is OECD and Brazil, and the balance sits in, as I mentioned, areas with long track records and history of mining. And the portfolio is perhaps unusually for a company of our market cap, but is primarily weighted to assets that are royalties that are generating cash flow. So the 50% of the estimated NAV in Ecora is over assets that are in production, and next call it 45% over assets that are in near-term development, and then the tail is longer dated assets. I think the last thing you should know about Ecora in terms of the overall portfolio complexion relates to the cost curve positioning. And we've sought to build a portfolio of royalties over mines or projects that are defensively located on industry cost curves. Approximately 80% of our portfolio by asset value, net asset value, is weighed towards assets that are in the first or second quartile of those commodities' wider production costs. And effectively what that means is, number one, if the asset is in production, it's likely to generate strong free cash flow through commodity price cycles, stay in production. And number two, if it's a development project, then the asset is most likely to have great economics by virtue of its cost profile, and thus most likely to attract capital through the commodity cycle and move at an accelerated pace towards first production. We've just announced our full year results for 2025, and there are a few key takeaways. Point number one relates to the contribution mix. And historically, Ecora has been weighed towards its legacy asset, Kestrel. We've obviously deployed a lot of capital to diversify and weigh this business to critical minerals. And 2025, in that sense, truly does represent a landmark year and a true inflection point for this business, where for the first time ever, more than 50% of our revenue was generated from critical minerals and not coal. Second, as a subset of that portfolio contribution, base metals represents and demonstrated sizable growth year on year. So our base metals royalties increased portfolio contribution by 150% in 2025 relative to 24, with further growth from our producing asset base expected in 2026. We delivered very strong deleveraging last year. In March, we acquired a $50 million producing copper stream. Our net debt following that transaction was approximately 125, and we ended the year with net debt just over 85 million, which is materially similar to where we were at the start of the year. And that really truly does demonstrate this portfolio's strong cash generative nature, but also some actions we took during the year to unlock value in legacy non-core commodities such as gold and monetize those. I spoke just now about how transformational and how much of a landmark 2025 was for Ecora. And you can see that here in this slide. This business in its entire history has been very reliant on one coking coal royalty, and that royalty is now approaching the end of its life. So first of all, 2025 is very important to reposition the sources of royalty cash flow to the core of our NAV in critical minerals. But number two is truly transformational in terms of the longevity of the cash flow profile itself. And by that, Kestrel had a royalty life that was always measured in years. And when you look at our underlying producing royalties and those in development, when they come into production, you then look at Ecor's royalty profile through a lens of multiple decades. And in that sense, it's truly transformational to the perception of the quality of the earnings that Ecora generates. And you can see the scale and pace at which the business's specialty metals and base metals have grown. So if you, on the right-hand side of the page is a chart, the solid blue and green line represents assets that are in production. And you can see something like a 6 to 7 times increase between 2020 and 2025. Looking ahead, though, it still does feel as if we're at the foothills of what this base metals and critical minerals portfolio more widely can offer. And while it's wonderful to now have demonstrated a portion of the cash flow generation potential that exists within Ecora, when you look at the next 5 years, it really does feel quite exciting. And that next 5-year growth outlook in many ways is underpinned by a number of potential milestones or de-risking events that apply, that are expected across our growth portfolio. And our growth portfolio sitting here today is more layered than it's ever been in its entire history. So that the growth profile over the next 5 years is a function of, first of all, mines that are already in production, ramping up to full-scale production capacity. Number two, the potential for operations that are in production to be expanded as a brownfield expansion, and that includes, for example, Capstone's Mantos Blancos, or also assets like Nifty that have historically been in production, but that are now approaching production restart. The third layer of our growth profile relates to assets that are really at the front end of a project development, so assets that are very well advanced in permitting, if not fully permitted, and are approaching this final investment decision stage. That includes an asset like Santo Domingo, which is owned by Capstone Copper, or the Palabora Rare Earth Project. And then in the longer assets that are not expected to generate income until the longer term, there are still some potentially key value catalysts. An asset like Patterson Corridor East, which is hard to describe as anything to date other than geologically exceptional. NextGen's drilling program is expected to continue over the course of this year, and hopefully will build upon the incredible success that occurred last year. You can see on this slide our material royalty exposures, and I won't go through each one in detail, other than to make a simple observation that while Ecora as a royalty company is small cap, the counterparties in aggregate to which we have exposure certainly are not. Ecora's portfolio includes a number of blue chip names in the mining sector, including Vale, Capstone Copper, Orano, Cameco, BHP, amongst others. So this royalty portfolio in aggregate, if you were to sum the market cap of our operator partners, you'd be well in excess of 300 billion. And on that basis, Ecora, yes, is small cap, but at the same time provides royalty exposure to a number of blue chip names on a very diversified basis across the critical minerals suite. And I've touched on this slide already, so I won't belabor it in too much detail, but this slide at a snapshot provides an excellent overview of overall commodity exposure. And as I mentioned, that's centered in copper. Our geographic exposure weighted to OECD and established mining jurisdiction, the stage of development weighted towards assets that are in production, and the cost curve positioning.
Mark, one of the points that you often highlight in terms of this transition from coal to critical minerals is the opportunity to trade at higher multiples as you make this transition. Can you maybe touch on that? And then as the second part, as Kestrel comes off over the next few years, which is where this coal exposure is coming from, what does that coal exposure look like now? And then what does that look like in 3-4 years' time?
Yeah, so let's take the first part of that question, which is related to trading multiples. I think number one, if you look across equity markets, it's pretty clear that valuation multiples generally to met coal are at a discount to those for base metals. And you see that across any equities for those producers of commodities. So over time, I'd expect that, and we've already started to see multiple expansion at Ecora, but I'd expect to see that as commodity complexion at Ecora evolves from coal, which is decidedly out of fashion, out of favor, and in some instances, very difficult for some fund managers even to own. As that commodity complexion evolves to critical minerals, you'd expect to see the valuation multiple change as we see in the market. And I think the second thing about Ecora is that we touched on this earlier, but you'd expect that an asset like Kestrel, which is a very finite life measured in years, would trade at relatively lower multiples, ignoring the commodity, to an asset that has multiple decades of mine life. So for those two reasons, it's very possible, and I'd expect to see some form of valuation multiple expansion at Ecora. We have historically traded at a fairly sizable discount to many royalty sector peers. And the Ecora equity has responded on the price side as this critical minerals portfolio demonstrated its cash generation potential, at least a portion of it from the producing asset base. But I think as we approach, and further just de-risk the producing asset base and then see an increase in contribution from critical minerals, there's still a long way to go potentially to trade in line with some of our peers. So that's certainly one of the opportunities at Ecora. And in parallel, I think when you combine the potential for multiple expansion just for absolute revenue growth, because at Ecora our portfolio has sizable organic growth potential in addition to the potential that exists in the producing asset base, it's really quite powerful.
Great. Yeah, I think that makes a lot of sense. And then maybe just going back to that growth profile here that you're coming up upon. Voisey's Bay is obviously a big contributor to that and had a strong 2025. Can you dive in a bit to the operation and expectations there as things ramp up?
Yeah, so really strong year operationally, operational execution and delivery. And in that sense, we would of course can really congratulate the Vale Base Metals team to achieve such an incredible year-on-year result. The asset delivered as part of its ramp up in the underground mining operations on more than 100% year-on-year growth in production volumes. And the asset is still not running at full production. So in 2026, we would certainly expect to see further volume growth from 2025. The other thing that occurred last year, which has been a quite helpful tailwind, was the adoption or implementation of an export quota framework from the DRC, restricting the supply of cobalt material in response to what was a very oversupplied market. So cobalt prices year to date and currently are averaging in the high $20 per pound. We'll see if they stay there in time. Nevertheless, that's well above where we were last year. So combining the volume growth and the current supportive price backdrop, we should see strong growth at VB continue into this year as well. But that's really only the beginning of the story. And if you're keen to better understand the potential for Voisey's, I'd encourage you to further study the Vale Base Metals Day materials that were released yesterday. Because the Vale asset, the Voisey's Bay asset is communicated by Vale, demonstrates enormous longer term life of mine extension potential. This is an asset that we've always seen internally as benefiting from life of mine extension potential. But now I think for the first time really since we've owned the stream, there's real tangible evidence of that contained in the Vale Base Metals disclosure.
Great, thanks, Mark. And then moving over to Mimbula, that was also a big contribution to the base metals portfolio through that acquisition last year. Can you talk a bit about the acquisition and what you expected to contribute to the portfolio?
Yeah, at a high level, that asset is perfectly straight down the fairway for Ecora. It just ticks so many boxes. You have a low cost operation. It was in production with a track record of low operating costs, but also executional delivery from what is a world-class management team who have delivered that project materially from inception to where it is today at a pace that for the mining sector is eye-watering. And the asset is currently undergoing an expansion. Production full year production the year before we acquired it in 2014 was around 14,000 tons of copper and is being expanded to 56,000 tons of production capacity. This is an open pit SXEW operation. So as far as mining copper, this is at the relatively simpler end of the curve. It's an asset that also offers some degree of life of mine expansion potential. So we think it was at the time last year, we feel it was the perfect next deal for Ecora.
Great. And then, I mean, one of the other big notable things in your results last week was the deleveraging in 2025. I think it really speaks to the strength of the portfolio. I mean, you made a big acquisition in Mimbula, and then you ended 2025 in essentially the same debt position that you ended 2024. So a big part of that was the cash generation that you spoke to, but you also mentioned that you divested a non-core gold asset. I mean, are there any other non-core assets in the portfolio that you're considering divesting moving forward?
I mean, that the royalty we sold, the Dugbe royalty, was a bit of an anomaly in that sense. First of all, development stage royalty in gold, really non-core to our critical mineral strategy. And we certainly did feel that from a market perspective, the asset didn't get a lot of attention in Ecora. And it was a type of royalty that probably is better suited to sit within the portfolio of a royalty company focused on precious metals, where the royalty's intrinsic value and growth optionality would be better recognized by the investor community. So in that sense, it does not. We don't have more of those under the couch cushion. But what we do have, I think, are some royalties that until recently folks are not really paying attention to, but offer explosive NAV growth potential. In particular, the next gen royalty at Patterson Quarter East. And I touched on that briefly as well, but as far as uranium royalties go, that certainly has the potential to be amongst the best uranium royalties globally in time. So it's certainly one to watch. I would say that commodity is obviously very core to Ecora, though. It's unlikely to be one that we'd look to monetize absent valuation being fully representative of the asset's potential to be directly comparable to Arrow.
Great. Yeah, and that growth profile that you keep touching on, it's one of the things that really attracted us to the story as well, both on the production side and then also the organic pipeline of these development projects. I mean, in 2025, you generated just under 60 million, and we forecast that up around 100 million by 2030, and then that's the same kind of place that the other analysts covering the stock are also forecasting. So can you maybe just touch on the key projects that are expected to kind of come online over the next few years to bring you to that point?
Yeah, so we've touched on the first leg, and that is just volume growth from the producing asset base. The second, the biggest one actually, is Santo Domingo. This is a Capstone copper asset, low cost, located in Chile. As far as mining distances go, stone's throw from their producing Manto Verde operation. This is an asset that, within the context of Capstone, offers significant district synergy potential, and that's something that Capstone has sort of disclosed and discussed in the past. And it's an asset that is now approaching what appears to be the final work streams in advance of an FID decision. So Capstone Copper has indicated that decision could come in H2 of this year. Something we're very excited about. That is an asset that could deliver substantial revenue growth for us when it comes online. And beyond that, has further sources of upside as well. That's not really in the base case from oxides, cobalts, and cobalt byproduct production and elsewhere. Speaking of Capstone Copper, one of the assets that's not one of the sources of potential growth that's not actually included in the consensus forecasts or that $100 million figure you referenced in potential royalty contribution in 2030 comes from Mantos Blancos Phase 2 expansion, which as of yet appears not to have been sufficiently defined for research analysts to include that growth in their forecasts. That study is expected to be released in the second half of this year, and that would be entirely incremental to the existing growth profile, which already we believe is very compelling.
Yeah, definitely a lot of growth to keep an eye on and look forward to. So a lot of this growth that is organic within the portfolio. I mean, looking inorganic, are you considering making other acquisitions? And if so, I mean, what would you consider in terms of project stage and commodity?
Look, I think what we feel at Ecora we've achieved now with this critical minerals portfolio, a very solid like platform and foundation. From a revenue mix, 2025 does represent a fairly sizable inflection point, but suffice to say, there's still a lot more work to be done. And what we feel, as I mentioned to you, Nick, is with the foundations we have, with the benefit of further diversification, we could really drive down this portfolio's expected volatility, further diversify by jurisdiction, counterparties, improve the portfolio's resilience, and of course, increase the business's growth profile. So to that end, we're focused on number one, materially maintaining our overall complexion from the balance of stage of development in terms of the weighting to producing near-term and longer-term optionality. And accordingly, when we do look at new acquisitions, the ticket sizes would of course be weighed. So the largest investments would be made into assets that are in production, and then relatively smaller investments into assets moving down the development curve. And naturally, as a consequence, the portfolio weighting overall is unlikely to change materially from its current overall shape. From a commodity perspective, we've been very deliberate in targeting base metals, in particular copper. And so we would, maybe we might see some sorts like divergence on a deal by deal basis, although the trend over the long term, the strategy would be to retain copper as our core commodity exposure. And to your question on what we might do next, from a ticket size perspective, the largest transaction would really be for things that are or royalties over or mines that are, if not already in production, offer a fairly short timeline to first production. And then we might consider smaller acquisitions over slightly earlier stage projects, but at much smaller ticket sizes.
And then you're also paying a dividend currently. What's currently the dividend policy, and then do you expect this to stay in place as you go through this growth phase?
Yeah, the dividend policy and the general capital allocation framework was introduced in 2024. And at the time, we felt, given Ecora's size and the market opportunity, that we should allocate more capital towards growth and buying royalties. And so in that period since then, we acquired a world-class rare earths royalty over the Palabora project and the producing Mimbula copper stream. And thus, I feel we've demonstrated that there's certainly an opportunity to deploy capital into high-quality opportunities and to keep growing Ecora. The dividend policy as it stands today is to distribute between 25 to 35% of the average of the two prior half-year periods free cash flow generation. And that policy in many ways was designed to adjust with the portfolio contribution. So in other words, as we roll forward in time and we see, and hopefully we'll see this growth coming through, you would naturally then see growth in the dividend policy, or in the dividend distributions rather. And to us, that makes a lot of sense. So in other words, we distribute more free cash flow as a fixed percentage of growing cash flow, rather than increasing distributions based on a higher percentage of a fixed cash flow amount or free cash flow amount.
Great, yeah, I think that makes a lot of sense. And then maybe just one last question from me, Mark. On the conference call last week, you mentioned that an inflationary environment benefits the royalty model. And I thought that was pretty interesting. Can you maybe explain that in a bit more detail for investors that aren't as familiar with the royalty model?
Yeah, at the core, the royalty model provides exposure to production and price. And so you don't have direct exposure to the cost of extracting minerals. And therefore, in an inflationary environment where really across the board, if you expect to see increases in the costs of production over time, that tends to drive nominal increases to underlying commodity prices. And in many ways, that's perhaps one of the most attractive natures of the royalty model is that you have this inherent defensiveness by virtue of not having that direct exposure to the mining operations, which also applies to capital costs. I mean, capital costs and operating costs are both prone to inflationary pressures. I think the last highlight, of course, of the royalty model, which is something that we could, if you have any questions on this topic, I'd encourage you as a viewer to just reach out to us as Ecora. But I think the royalty model, in addition to offering that top line exposure, offers diversification across counterparties, assets, jurisdictions.
I think that wraps up my questions for you, Mark. Any closing remarks you'd like to end on?
I just wrap it up simply by saying that we're very excited to have delivered 2025. Uh, we feel really delivery on some key fundamental milestones for Ecora, which is number one, demonstrate the free cash flow potential that exists, which is still a small portion of what this business could generate in time from its existing and a royalty portfolio. Number two, we feel that we've delivered strongly on the deleveraging and the business retains the flexibility to pursue further growth. And number three, it's a very defensive business model that's well positioned to potentially weather any macro uncertainty, but beyond that, it provides direct exposure to some commodities that have very strong fundamental long-term supply-demand balance trends.
Awesome. Yeah, lots of growth on the horizon. We'll be following along. And for our listeners, if you haven't seen our research, you can find it on our website at atriumresearch.ca. Thanks for your time, Mark.
Pleasure. Thanks for having me.